I'm Dr. Frances Rahaim with Hug Your Money, and I'm joined by Ben Braverman from SMS Financial Solutions. And we're going to talk about what Ben has coined as a phrase, annuity gotchas. So I hope you'll learn a lot from this and decide whether annuities have a place in your portfolio or not. So welcome, Ben. How are you?
Quite well this morning, Frances. Thanks for the time and consideration. These episodes are more and more fun every time we do them, and I'm just glad that we're getting the message out there of where an annuity does and does not fit.
Well, I think it's a worthwhile series, and we field a lot of questions about annuities. If you've heard the word annuities and you think that's one product, it's about the same as hearing the word cars and thinking that's one product. There are so many different kinds of annuities. Really quick crash course. There's a lot of different kinds of annuities. Everything from what I call the plain vanilla fixed annuity, which works a lot like a CD does. It has a designated interest rate, and that's it. It's very simple to understand. There's something called an immediate annuity, where you lock up your principal and can never touch it again, but you do it in order to protect that principal from losses, let's say to a nursing home or other kind of environment. There are variable annuities, which have fees associated with them and also could have risk to your principal. And then there are indexed annuities, which feel a lot like a variable annuity to people, I think, when we first start to explain them, because they have earnings that are linked to the market, but your money is not directly invested in the market. And so in indexed annuities, you have principal protection, you have some liquidity, and you still have the upside potential of the market. And we'll go into more detail in another segment about indexed annuities specifically, but I just wanted people to understand that when we say annuities, it's not one specific thing. It's a broad area of product, and we're going to talk about some of the things that give annuities a bad name and whether they're really a gotcha or they're not.
You articulated that so well, as you always do, Frances. And I always like to think about the different kinds of annuities as a risk spectrum, risk and reward, because that's really what we're talking about, risk and rewards. So as you said, your straight fixed annuity is much like your CD. And if anyone's looked at their CD rates lately, not a whole lot of risk, but not a whole lot of reward. Then you have an indexed annuity, where you can participate in an index reflecting some kind of market-like return. And that's zero risk, but there's some considerable more reward. And then you have a variable annuity, where there's quite a lot of reward, but just like your managed money account, your 401k, your IRA, you could just as easily lose all of that initial principal. So I thought that was a great way that you articulated that. I know specifically today you wanted to talk about annuity gotchas. Annuity gotchas is something that I talk about with advisors quite frequently in terms of better refining our message. What I really want to accomplish here is to pull back the curtain and have a level of transparency for consumers. So while these products may be complex and innovative on the surface, they're here to do a job, and they do it quite well if it's the right product for the right person and you're working with the right advisor.
I'm sorry, Ben, let me just jump in for one quick second and just tell people that you are not a salesperson for annuities. You're not trying to explain the product so that somebody will buy the annuity. You work with an IMO, which is sort of a middle company between the annuity companies and someone like myself as an independent broker. So I might rely on you for your information, but at no time are you earning a commission on these products or trying to sell them to the client. And to that end, I know we'll talk about fees, but I just wanted to get the one little thing in there about a variable annuity, in that in addition to the risk that you might have to your principal, you also have to pay attention to what fees are being taken out of your earnings every year. So sorry to interject, but I had to get that out there so people know where you're coming from.
Exactly. I've always worked in an institutional capacity, primarily with registered reps and RIAs and independent agents. And what that means is I don't deal directly with consumers, but the sheer quantity of things that an advisor does throughout the day to sift through the enormous quantity of products is the reason why I act there as a third-party intermediary between annuity carriers and advisors like yourself. So excellent point. Do not call me, call Frances. I cannot help the individual consumer. So back to our annuity gotchas. Annuity gotchas fall into one of two categories. One are things that I wish consumers or advisors would relate to consumers to be cognizant of in terms of issues with some products. There's things to be cognizant of. There's language to be cognizant of. And then the other section to annuity gotchas is just general misnomers. And we covered some of that in another episode. So let's start with one of the biggest gotchas that I'm aware of, which is misconceptions about bonuses.
Yes, for sure.
Bonuses can be a positive, bonuses can be a negative, but understanding how those bonuses are allocated and where they're allocated, that's something that the consumer really needs to be aware of. And unfortunately, not with you, Frances, but some agents and advisors need to be aware of as well. What I mean by that is bonuses can come down in one of two ways. Sometimes they're assessed on what you call column B, or an income benefit or a death benefit, but it's not real money. And sometimes it's real money to the cash account. But when you're sitting down with an advisor and they say, I'm giving you a 20% bonus, well, you need to ask yourself as a consumer, and I work with all these product companies, so I'm being very honest here. You need to ask, where's that bonus go? What does it cost me? And when is it fully realized?
Yeah, let me jump in for a second and translate as we've been, this is our pattern. You tell us how it works and then I translate it. And not that the general public doesn't always know this stuff. Some people are very savvy, but for those who may be confused by this, when we're talking about an indexed annuity, the way I describe it to people is if we're purchasing, let's say, an income rider on it, that index annuity might be split into two columns. And this is just on paper. Column A is your real value in the product. If you walked away tomorrow, this is what you're going to be getting, or this is what they're basing the value of your contract on. So let's say column A is $100,000. Column B, if we've purchased, let's say, an income rider in this case, could be a totally different number, usually higher, of course. And column B is sort of a phantom column or not real money, but it grows at a rate so that they can decide your income payout based on column B. So column A might be 100,000, column B might be 150,000 by the time you take income. Can you walk away with 150? No, but you're going to get income based on that if you follow the guidelines of the annuity. This is why you need somebody who understands this sort of stuff. But when Ben is talking about, when you're talking about a bonus and where is it, what we're trying to say is it real money? Did it go into column A? And if you change your mind 5 years from now and you walk away from the contract, can you take that bonus with you? Or did it go into column B, which might be useful to you, but you just need to understand, hey, that's not real money. It only comes to me if I, for instance, take lifetime income. And every contract's got their own little rules. So when we talk about these things, we're really talking in generalizations, but correct me if I'm wrong, Ben, but that's what I think you're saying is if I'm getting a bonus on this contract as the client, I need to understand, did it go into column A? Is it real money I can take? Or is it in column B and it will affect my income, but it's not real money?
Exactly. And a gotcha isn't necessarily a bad thing, but it could be a misunderstanding that down the road means you didn't get what you wanted. And from a sales perspective, bonuses are really attractive. If somebody tells me I'm getting 20% or 15% or 30% on anything right out of the gate, on the surface, that's really exciting. But what a good advisor does, working in consultation with a good product partner, is make sure that the client fully understands if that bonus is worth it and if they're really getting something of value, or if they're simply looking at something attractive that's not really going to do them a long-term benefit.
Yeah, certainly. And I think that very often I see things on the internet that are advertised, and people will say, well, is this too good to be true? Well, we're calling it an annuity gotcha because if that bonus is misrepresented, let's say by an agent, even unwittingly, and most of the time I think it is unwittingly, uh, then somebody thinks, oh, gee, I'm going to get a 15% or a 20% bonus on my money right away. Even if I only earn 3% on the contract, that bonus made it totally worth my while. Well, it might if the bonus is where you think it is. And that's where I think the kind of thing we're doing in this series, where we really talk about how these things affect people, is super important. And I just want to interject here for a second that I know when we're talking about this, that people's hair hurts thinking about this. Like, oh my gosh, this is so confusing. This is a complicated product. I don't want that. I want something simple. I want to call the guy who says to me, yeah, we just diversify, dollar cost average. It's all going to be fine. And don't worry about it. I wouldn't be spending time with you doing this if I didn't think these were a worthwhile product for people, if they understand them and if it's the right fit as part of their portfolio.
And when you're talking about that dollar cost averaging, I mean, these products are meant for pre-retirement and entering retirement. And a typical money manager, a typical stockbroker, and I'm going to be careful here, but let's have an honest conversation about those wirehouse individuals, right? What are they going to say when you start entering retirement? Oh, we'll put you in some dividend paying stocks and you're good to go, all taken care of. Is that really addressing sequence of returns risk, which we've talked about in other episodes? Or is that addressing longevity risk? At the end of the day, individuals focusing on debt acceleration and retirement planning have a different mindset and a different approach than the typical money manager who may, up until this point, has done a very good job at the accumulation phase before retirement. We're not talking about accumulation. We're actually talking about safety of principal and long-term retirement plan, which is about the sustainability of income. And I know that was off the subject, but when you brought up the money managers, I was on a webinar yesterday where that was very well articulated. And I thought about conversations I used to have when I worked in the securities industry with individuals in the wirehouse channel. And that is their answer to retirement.
Yeah.
We'll shift to a conservative bond portfolio now. Sorry,
I think that's great. This is the kind of real conversation we want to have, Ben, because this is two total financial geeks going at it like a couple of bulls here, and the fact of the matter is, the reason we do it is to help people sort out this stuff.
It's true about the Wire Channel guys too. I was on a webinar with Frank Maselli and he brought that up and I was like, that's so true. They're always looking at the fee-based managed money platform and they never think about the idea that even deaccumulation could potentially be beneficial in terms of stretching the sustainability of the income portfolio. But the next annuity gotcha that I'd like to discuss is all or nothing, right? I think this is the biggest misconception in the index, especially the index annuity space, which is Francis wants all my money. Or we're trying to get every slim dime. Two things. First of all, an indexed annuity, whether it's for income or safe accumulation, is a complement to a portfolio. It's not meant for a portfolio in its entirety. In fact, we're often faced with the challenge of once a client fully understands just what some indexed annuities can do for them, they want to put all their money into that indexed annuity. And from a regulatory perspective, by law, we can't.
Yes.
So this all or nothing concept, which I think is very prevalent. Somebody put all my money into an indexed annuity and I never saw it again. That's just a misnomer. And the gotcha is this is a complement to what you're doing. This isn't meant for the entirety of your portfolio, but it certainly should be a section of it. Yeah, is that a fair gotcha, Frances?
I think it's a fair misunderstanding for sure. because we absolutely have to balance out how much cash is left out and what money is at risk and what money is moved to safety and why. And we often have to write, descriptions and ask for permission to put money in. I had a woman I wrote letters for and still couldn't get it done. All of her money was in a 401k. All of it was in a 401k. And she left the company. And the company told her she had to take that money. And she did not want risk to her principal. And she didn't want to put it in a CD. And she wanted to put it all in the annuity, and the company would not take it. And she actually decided to, I should say, take some of the money out and diversify it into mutual funds. She was so angry that she couldn't put it all in the annuity because she liked what the annuity did. But, we have to balance this stuff. And I think you made the statement about, somebody saying, I put all my money in an annuity and I never saw it again. Okay, not likely. If you've heard any kind of statement like that from anybody, I mean, these products are designed for safety. They're designed for a conservative investor to do better than they might do in a typical conservative account like a CD or a money market or whatever, and to not have the exposure to risk that you might have in stocks, bonds, mutual funds, or even a variable annuity. So yeah, fair gotcha. What do you got next?
If it's too good to be true, this is where you're really going to have to start translating, Frances, but I think that it's an important point. So almost all these states, all 50 states are part of what's known as the NIAC regulatory group, or a NIAC state. And per NIAC regulations, illustrations, which is typically what an advisor is showing you, has to rely on the last 10 years of performance. That's all they have. That's what by law they have to show you. What would this index, which is a reflection of participation in an indice, done for you over the last 10 years? Well, guess what? You don't need to be an expert on the economy to know that the last 10 years was actually pretty darn good for much of it. Unfortunately, there's carriers out there where things are looking very, very good. I'm talking about 9, 10, 11% returns. And as a consultant and as a wholesaler marketer, that makes me deeply uncomfortable. Because once again, as Frances has mentioned, these products are 100% premium protected. And I think that we need to set a reasonable expectation of 4, 5, 6% returns. So if you sit down with an advisor and they show you 11% return and you can't lose a slim dime, or even 9% and you have 100% premium protection, I'd rather work with the advisor who's going to underpromise and overdeliver than the advisor who's going to lead with something that attractive. Because this is a conservative investment vehicle. Because as we've said time and time again in these episodes, which I think are so valuable, this is retirement. We're no longer seeking alpha. We're seeking sustainability.
Yeah,
Frances, translate.
Okay, translate. So I do see those ads on the internet that say things like 8% guaranteed. If as the client, you are not able to get a sample of that contract and read it and understand it, then your antenna should sprout out of your head when somebody says 8% guaranteed. Can these products earn that? Of course, we've all seen them in certain years have those kinds of earnings. The important part that I explain to people is that you're not going to have 10-0 years. The market goes way down, you might have no earnings that year, but you're not going backwards. And so you're sort of ratcheting in your earnings. Every year that you're making money, you're locking that in. The next year, you're starting again. If the market goes backwards, your principal is protected. And in most of these products, that earning is protected as well. So would you give up, 8%, supposed guarantees, which is not true anyway, in return for something reasonable? If this sounds reasonable to you, hey, look, I'm willing to make 4, 5, 6% a year with my principal guaranteed. And I know if the market is really bad, I might have a 0 earnings year. But what I won't have is 10 0 earnings years because these products almost always have or they do always have a minimum interest rate guarantee as well, which is usually somewhere around what CDs are paying or money markets are paying. So the actual picture is, okay, I'm going to go into a product where I know my principal is safe. So at the end of the day, I can put my head on the pillow, and if the market crashes, I know, okay, I didn't lose that money. And when the market's doing well, I'm going to earn reasonable gains in it. And if I'm wrong and the market is bad for 10 years, I'm going to have a minimum interest rate guarantee, which if we're getting that minimum interest rate guarantee of, 1% or whatever it is, we've got big problems.
I always call that the zombie apocalypse.
The zombie apocalypse. Yeah. I just think it's true, Ben. If it sounds too good to be true, you should be asking questions. Now, does that mean that when I explain an annuity to somebody and it's the right fit, is it going to sound great to them? Yeah, I hope so. It's
Exactly.
the perfect fit for them. It should sound great. But there's always some balance, which is going to bring us to a gotcha, I bet, of surrender charges at some point.
That is on my list, and to your point of the whole concept of is it too good to be true, indexed annuities have gotten more and more innovative, more and more well-developed, and more consumer-friendly as the years have gone on. So there are things that we can accomplish now with indexed annuities that couldn't be done.
That is a great place for me to say someone should check out the piece on the income rider, because when we were talking about the accumulation phase versus the protection phase, yeah, that's great. But with an income rider, you could still be accumulating that column B to generate more income than you expected without the risk of the accumulation phase product that you might have been using.
There's no longer a reason that you have to sacrifice cash value for guaranteed income. Another annuity gotcha would definitely be the certainty of RMDs. So we talk about income quite a bit, as in guaranteed income. But not every client needs to maximize their income in retirement. Some people might have saved quite a bit of qualified assets, and they also have a fair amount of non-qualified assets, pre-tax and post-tax dollars. And one certainty on the qualified assets, one guarantee that you can have is that you'll have to take your RMDs. And the question, if you have an IRA inside of an indexed annuity and you have some kind of enhanced death benefit on it, is how do those RMDs affect that enhanced death benefit? And the annuity gotcha is it dollar for dollar or is it pro rata? Why is that an annuity gotcha? Because a lot of annuity contracts out there reduce benefits on a pro rata basis, others on a dollar for dollar. What's better for the consumer? Dollar for dollar. Why? Because it's exactly as it sounds. If you pull out $5,000, it's going to reduce your death benefit by $5,000 versus other contracts where you're going to have what's known as a proportional reduction. A proportional reduction means that it's going to be a percentage of. It's not going to be that simple and straightforward, which means if you're trying to satisfy your RMDs, which you have to take your RMDs, not this year for everyone that's trying to gotcha me out there, but in any other year, you have to take your RMDs now at the attained age of 72, and you're still trying to maintain some cash value or leave a legacy to your spouse or beneficiary. You want to know that death benefits being reduced on a dollar for dollar basis, because proportionally is going to decimate that legacy.
No, there's no way around that. That is a gotcha, that if your representative or your agent doesn't talk to you about that or doesn't know that, that's the kind of thing that comes back to bite you after you're already in the contract. And now you're 72 years old and you take your required minimum distribution, RMD for the rest of the world. And now you're upset about it. And what happened? Well, your agent didn't talk to you about that or didn't notice it in the product when they put you into that product. So you have to be able to forecast for the client what kinds of things will affect them down the road. That may not be the biggest deal for some people, and for other people, it's a very big deal. I don't need to belabor that point. That's a definite gotcha.
Another one, we hopefully by now, if you're watching these videos, you at least have an idea of what an income rider on an indexed annuity is. And if not, I'm sure Frances can direct you to where to go to learn what an income rider is. So you've bought your indexed annuity, or you're thinking about purchasing your indexed annuity, and you have an income rider. What you need to wonder is, can I take withdrawals before triggering income? Not only that, but what do those withdrawals do to my income benefit? Because unfortunately, there's a wide variety of products out there. There's a wide variety of tools, and the wrong tool in the wrong hand for the wrong person can be a bad deal. Let's say you're planning on triggering income in 10 years. Well, if you take a withdrawal in the 5th year, that's going to automatically lock in your income guarantee at that point, lock in your income benefit, or destroy your roll-up. And some consumers aren't aware of that. Furthermore, some agents don't stay in contact with the consumer after they write the policy, which would be another question I would ask your advisor. If this is the first transaction we're doing together, what's your follow-up process? Are you going to continue to stay in touch with me? Because had they known that that withdrawal was going to either impact or even destroy this income benefit that they paid for, ideally on the front end, someone should have made them aware of it. And that's a big annuity gotcha. Along with, is there a designated time that I have to trigger my income, or do I have the flexibility to trigger it when it suits me? As retirement, as much as we try to plan it, is fundamentally still a fluid part of the overall lifespan. So.
Okay. Wow. So many pieces there to talk about. First of all, you are
Was that too much, Frances? I'm sorry.
No, don't be sorry. It's great. I really think it's wonderful that we do this. So, but let me try to break it into pieces. You can remind me if I'm missing something. First of all, for the listeners out there, we are not talking about like it decimates your fruit roll up. A roll up is the amount that your income is increasing by every year. I think in one of our segments about income riders, and believe me, there are so many different kinds of income riders, you really need somebody who can help you sort that out. I think we talked briefly about one of the companies out there that has a 7% per year roll up on the income side. So basically on the column B, that's going to roll up by 7% a year. It's got nothing to do with the fruit treats that you get out of the box. Secondly, when we're talking about triggering income, we're not being violent. All we're saying is you can turn on your income, but when you do, you have to remember that annuities are contracts. They're legal contracts with an insurance company. And so there are clauses and features that get activated or not activated. And triggering your income means you're saying to the company, I've made a decision to draw a line in the sand here. I've decided to start taking my income. And some of those income riders do exactly that. You take your income, that's it, decision made, can't change your mind. Others allow you to turn the income on or off. For some of my self-employed people, for instance, there might be years where they make a lot more money in their business and they don't really want that income coming in from the annuity. They can turn it off that year if they want to and turn it back on with the right rider. When we're talking about triggering income or taking withdrawals, I know to the person taking the money, it all feels like income. That's a sort of a catchphrase we use for money that comes into the household, it's income. But to an annuity company, that is not the same thing. A withdrawal is taking money out of the cash value, and income is triggering that rider that you've got or turning that annuity into a stream of income. So they are very different things to the insurance company. Did I miss any lingo there?
You hit it right on the head. And before we get to the final annuity gotcha for today, I have to say, I do want to say something, Frances, which is, in all sincerity, a lot of advisors I work with put out different kinds of videos or content to try to educate consumers or to try to draw in clients. And usually it's a 10,000-foot view of debt, Social Security, taxes in retirement, and all the things that I know that go into your comprehensive financial plans. But to help consumers really get under the hood of the products that we're utilizing, to me, that's taking a next step in the transparency that this industry so very much needs. So compliments to you for taking that initiative, and thank you for letting me be a part of this.
Well, thanks, Ben, but I mean, I don't mean to take any credit for it, because really, you know, I've been doing this for 34 years, I think in March it'll be 34 years. And the one thing I know to be true is if you explain things to people in a way that they can wrap their minds around it and feel good about it, they know, people are smart. They know whether that's the right fit or not. And they know when they're just being bullied, when somebody's just trying to belittle them by speaking in some ridiculous language that doesn't mean anything to them and scare them into buying. That never feels good. And you know, you mentioned asking people what their follow-up process would be if this is the first thing that you're doing. And I would add to that, if this is your first transaction with an advisor, get references, real references. Now, I know the advisor will only give you good references, but let me tell you, if they can't or they're resistant to it, I would worry. I mean, you know, we have a list a mile long of people who you could talk to who have been with us for year after year after year, who know that when they need me, they call and I answer, or they text me, or they email us, and we're there for them. So yeah, those things are really important. You don't want to trust somebody with your money that either isn't going to be there tomorrow, or who doesn't have the answers you want, or who is afraid to say, I don't know that answer, and let me get an answer for you. Those are all red flags to me.
That's Annuity Gotcha.
Yeah. Okay, good. What is it?
Surrender penalties.
Ah.
Being penalized doesn't sound good, does it? Well, and oftentimes this is something that people talk about with indexed annuities as a really bad thing. Oh, you're going to pay surrender penalties. You don't have access to all your money. This is a really bad thing. And you're right. Indexed annuities do have surrender charges. Usually in an indexed annuity, you can access 5, 7, 10% of your money on an annual basis during the duration, the CDSC, the contingent deferred sales charge, which can be as short as 5 years, as long as 12 years, and in some indexed annuities longer than that. Those surrender penalties are there because the insurance company needs to price that product in order to pay you, to pay your gains, to sustain the income, to sustain the benefits, to keep the lights on, to pay the person at the insurance company who services your product. But the other thing that I like to bring up, and some people think this is maybe this is why I don't work directly with consumers, as Frances mentioned earlier, I actually think surrender penalties can sometimes protect you from yourself. There's a great economist named Roger Ibbotson who studies behavioral finance. Individuals, when left to their own direction with respect to their finances, make poor decisions. I'm sure we're all guilty of it. So isn't it nice to know that a portion of your retirement is not only protected from market volatility, is not subject to an enormous amount of fees, but in addition to that, you know, when you've seen something on the news, or when you get the perception that the sky is falling, and we all occasionally have that sensation, that money in that indexed annuity, you probably won't pull out in its entirety, because those surrender penalties are going to protect you from your own bad behavior.
It's the same idea behind a CD, except the penalties on the CDs are so small, people just walk right over them anyway. And you don't have—
As are the gains.
Yeah, as are the gains, that's right. And you don't have the liquidity. If you want to take your money out of the CD, you're going to pay the penalty. They don't say, well, you can get 10% out this year, and anything over that will pay a penalty. We'll charge a penalty. So I see surrender charges also when they're explained properly to people, and when the product is the right fit, as almost a moot point. So what I mean by that is, if I'm recommending an indexed annuity for somebody, and they have a reason that they're going to want more than, let's say, 10% of their premium, their balance per year, then I'm probably recommending the wrong product. They need more liquidity than that. They shouldn't be putting that much money in the annuity. So in 30-something years, I don't think I've ever had anybody, and that's a big statement, but I don't recall a single person having to pay those surrender charges to pull out of an annuity. because it's a balance. It's part of the portfolio. It's designed to fit. When it fits, the person is probably never going to take out more than their minimum withdrawal, or they're going to let the contract get to fruition, and then they're going to use the income or take the money out or roll it over or do whatever they want at that time. You know, I would rather have those surrender charges in case somebody takes out more than the minimum withdrawal than to have fees on the front end, like many of the products do, that are reducing your premium. In an annuity, 100% of what you're putting in is going to work for you immediately, less any of the little rider fees we're talking about. And if we're recommending something with a rider charge or some sort of charge, it has to really be worth it. We have to be able to show the person why that's worth it. So surrender charges, you know, can you beat up on them? Yeah, you can complain about surrender charges all you want, but if you're really worried about seeing those, it's probably not the right fit, in my opinion.
And I would wholeheartedly agree with you, which I think we can close with compensation today. We've touched on it before, but if it doesn't make dollars, it doesn't make sense. And this is all about transparency, right? So if all of your retirement assets are sitting in a managed money account or a fee-based account, and I'm not going to mention any names, obviously, for compliance reasons, what are you guaranteed? You're guaranteed two things. You're guaranteed fees and volatility. You're not guaranteed principal protection. If you can find me a money manager out there that can say, I can create you a guaranteed income stream that will live the rest of your life, no matter how long you live, I'd put my money there today. If you can find a money manager out there that can guarantee that a portion of my money will never go down, I will put my money there right now. The fact of the matter is that's not true. What can a properly trained advisor with integrity get you with an indexed annuity? They can provide 100% certainty of premium protection. They can create a guaranteed income stream that will never run out. They can create guaranteed legacies of tax efficient natures. We can say the word guarantee, and that goes a long way.
Do you know why I love in particular that you said that? Because you and I both know, whether anybody ever believes us or not, we do not script these pieces. We just get in a meeting and just chit chat, and whatever we get, we get. And it's very open and honest. But you're not selling annuities to people directly. And I love that both you and I came from a securities background. I was a registered investment advisor. You had 7, and I think you had your stockbroker's license before you had an annuities license, right?
Yeah, I had a 7 and a 63 before I ever had a life insurance license.
Yeah, and I came from that securities world as well. I mean, I started out with John Hancock and got my securities license and got my registered investment advisors, and then, you know, of course, my Ph.D. So I just love that here we are on the other side of that, which most securities people would say, oh, you know, annuities, they will never say they don't understand them. They'll tell you why they're bad. And we've come full circle and dug in under that and end up saying the kinds of things you just said, which I think it's why they're so popular. When I talk to somebody about them, I offer them a number of different options. I work with brokers who handle securities. For my investors, which are mostly conservative, you know, getting closer to retirement or retired already, they love the idea of principal protection, decent market gains, reasonable stuff. I mean, who doesn't want that? So yeah, I really appreciate that you said that, because I had no idea you were going to say it, but that was great. I hope you'll come back. We'll do another segment digging into annuities further, but I thank you for sharing your annuity gotchas with us. And I just want to thank Ben Braverman and SMS Financial Solutions for your time and for allowing us to do this. I think it's really great to get this inside baseball out there to the public and let them make informed decisions.
Likewise, Frances, I appreciate being part of this. As this industry grows, we want it to grow because of advisors with integrity, advisors acting with transparency, and advisors utilizing the tools in the correct manner. So I think this is phenomenal content, and I'm looking forward to seeing the dividends that come from it.
so to speak. Thanks, Ben. We'll talk to you soon.
Have a fantastic week. Thank you so much, Frances.
You too. Thanks. Your success is our goal, so please contact us if we can be of further assistance.